Have you ever wondered why smart people make poor investment choices? The field of behavioral finance might have some answers. Behavioral finance is an intriguing study that combines psychology and economics to understand how human behavior affects financial decisions. Unlike traditional finance, which assumes rational decision-making based on maximizing utility, behavioral finance acknowledges that human behavior is often influenced by biases and heuristics. One of the most common investor biases is overconfidence. This is when investors overestimate their knowledge and ability to predict market movements. For example, an investor might buy a stock believing they have inside knowledge, only to find their prediction was wrong and the stock price falls. Then there's confirmation bias, where people seek out information that confirms their existing beliefs and ignore conflicting evidence. For example, an investor might only pay attention to positive news about a stock they own, while disregarding negative reports. Loss aversion is another common bias. This is the tendency to strongly prefer avoiding losses over acquiring equivalent gains. For instance, an investor might hold on to a losing stock, hoping it will bounce back, rather than cutting their losses and investing in a better performing asset. Anchoring bias happens when investors give too much weight to the first piece of information they encounter. For instance, an investor might stick to the first price they paid for a stock, ignoring current market conditions. Then there's herding behavior, following the crowd without conducting independent research or analysis. For example, an investor might buy a popular stock just because everyone else is, not because they've assessed its value. Framing effect, regret aversion, availability, heuristic, and sunk cost fallacy are other biases that can lead investors astray. These biases impact investment decisions in many ways. They can lead to skewed asset allocations, poor stock selection, attempts at market timing, excessive portfolio turnover, and incorrect risk assessment. But all is not lost. By understanding and acknowledging these biases, investors can mitigate their impact. Education and awareness, diversification, maintaining a long-term perspective, and consulting professionals are all strategies that can help. Continuous monitoring and adjustment of your portfolio is also crucial. Regularly reviewing and rebalancing your portfolio can help ensure it aligns with your financial goals and risk tolerance. So, beware of these biases the next time you make an investment decision. Remember, knowledge is power, and understanding these biases can help you make better, more rational financial decisions.